You might have wondered, what is the economic status now? Let's find out by looking at some of economic indicators data and then correlate it with the economics theory concept to find out. I will use WWH approach. What, why, how to understand the status. No big deal, no bother, just 3 questions to understand the status. Economies go through periods of up and downs and consists of 4 stages: expansions, peak, contraction, and trough. This known as economic cycles. From historical data, 17 months is the shortest ever economic cycle in the U.S., occurring between 1920 and 1921, National Bureau of Economic Research 2023. In this video, I will back and forth refer to economic theory and examine the real-world data for finding clues. Governments, agencies, and economists study a wide range of indicators, such as market rates, to reflect fluctuation prices of commodities, etc. Economic activity, to measure supply and demand behavior in different economic sectors. Balance of payments, to know the export and import flows of products and services. Labor markets, to understand unemployment rate and inflation rate. Due to time constraint of this video, we only focus on labor markets and inflation rate to get some insight about economic today. You may have heard that last year, Qualcomm cut 1,258 jobs, and LinkedIn laid off 668 employees. In March 2024, Citigroup announced plans to cut 5,000 jobs, followed by Intel in early August 2024, which is reducing its workforce by 15%, or approximately 15,000 jobs. Additionally, Dell has let go of 12,500 employees, and Cisco has cut 6,000 jobs. So far, the combined layoffs in the tech industry have impacted around 98,000 jobs. From trade economic data, you can see from the graph that U.S. unemployment rate has increased from 3.80% in early September 2023 to latest September 2024 of 4.20%. Due to Federal Reserve's intervention of raising interest rates, we could see U.S. inflation rate has dropped from its peak of 9.1% in June 2022 to 2.5% in August 2024, nearing the Fed's target of 2%. Inflation is the increase of prices of goods and services over a period of time, typically measured annually, and it can also reflect overall rising costs of living. Inflation is made up of 2 types: cost push and demand pull. In this case, the inflation is primarily driven by cost push factors such as supply chain disruptions caused by the ongoing Ukraine-Russia war, which began on February 24, 2022, and the recent Israel-Hamas conflict, which started on October 7, 2023. These supply-side instabilities help explain why inflation peaked in 2022. In theory, the plot of inflation rate versus unemployment rate, known as the Phillips curve, illustrates the relationship between inflation and economic activity. For example, during periods of economic growth, when economic activity is high, increased buying and selling of goods and services, there is high demand for labor, firm or companies will produce more, and more workers will be employed, incomes will rise and people will spend more, leading to higher prices, higher inflation, and lower unemployment. In contrast, when economic activity is low, companies reduce their workforce, resulting in higher unemployment. Using ChatGPT to plot the latest September 2024 real-world Phillips curve data from sources like Trading Economics, we can observe an inverse relationship between inflation and unemployment, consistent with the theoretical Phillips curve. In this case, it is the latter. The latest result shows that U.S. inflation is declining and unemployment rate is rising. This can be seen as signal that the current market economic has high chances. Probability is an economic downturn. In worst-case scenario, recession, the economy activity will decline, and chain of events will perpetuate across all economy. It will cause firm or company go bankrupt, which will result many people lost job and incomes. This will then in turn cause households consume less, and this spending drop will then cause more firm or company go out of business and become negative cycle. To stop this, governments will need to use fiscal and monetary policies to break this negative cycle, and this will take time. Next, let's move to see the U.S. interest rate graph. As you can see, the U.S. interest rate has gradually increased from post-COVID era in mid-2022 of 0.25% to August 2024 of 5.5%. In latest news, with the current 2.5% inflation rate and unemployment rate of 4.2%, the United States Central Bank, Fed, on Wednesday, September 18th, announced its first interest rate cut since March 2020 to a 50 basis point reduction in its key lending rate to between 4.75% and 5% from the 5.25% to 5.5%. What does this mean to us? What are next steps we could expect? In my personal views, the interest rate cut goal is to stabilize the economy by stimulating more spending and increasing market liquidity. I do expect, in the face of uncertainty, investors may shift towards safer hedging assets like physical gold. Additionally, there might be a movement of capital from treasury bonds to higher return investments. But bear in mind that it's important to consider that factors such as the upcoming U.S. presidential election or unforeseen black swan events could disrupt these expectations. Hence, please be cautious and take responsibility when making investment decisions. If you found this video informative, don't forget to like, subscribe, and hit the notification bell. Thank you.